G'day guys, Jay Senior here and welcome to another episode on the Australian Wealth Channel. And in this episode, we're going to be talking about how to set yourself up financially. So thank you guys so much for watching. Please make sure you like and subscribe to this channel. It really helps to get these videos out to more people. So in life, we all start from different places. You know, it would just be absurd to think that every single person around the world starts in the same place because it's so obviously not the truth. But having said that, regardless of where you start, especially in the Western world, I'm talking about, with a little bit of hard work and some elbow grease, we can succeed if you take ownership of your situation. So in this video, I wanted to talk about some of the things that I've done to help set me up financially for the future at the young age of 29. Now, of course, this has to come with the disclaimer. This is what I'm doing and what I've seen be successful. What I'm talking about might not work for you. So obviously take this information with a grain of salt. It might not be right for you, might not be the right financial advice for you. So I'm going to talk about what I've done and some of the things which are pretty basic common knowledge within the finance sector of what people should do with their money to see success. Now, the very first thing that you need to do in regards to your money is smash the like button, subscribe to the channel. No, I'm just joking. So the first thing we need to look at is what we call an emergency fund. So this is a fund of 3 to 6 months worth of expenses that you can have put away just in case there's any kind of mishaps or problems that come up where it's an actual emergency and you need access to cash fast. So based on what we've seen in the last couple of years and the economic environment that we currently live in, I'd be erring more towards the side of 6 months rather than 3 months because there's so much uncertainty around a lot of different things which we are all aware of. So maybe look at 6, maybe even 9 months if you want to be a little bit more secure. I probably wouldn't go any more than that. So calculate your monthly expenses and have a look at how much you're spending, and then you want to put away at least 6 months worth. So say you spend $2,000 a month on, things like mortgage, car repayments if you have them, food, things like that. You want to be putting around 12 grand away if your monthly expenses are around $2,000. So the important thing is that you do not use this money unless it is an actual emergency. It's not just like a fun account that you can then top up later. You want to keep this completely separate. So that's the first step. Now, step number 2 is to get rid of any consumer debt that you currently have. Now, there's a lot of strategies that people will use about investing in consumer debt. If you're just kind of getting started and you're just looking to set yourself up financially, the first step is to get rid of consumer debt. So consumer debt is things like balance payments on credit cards. You shouldn't have any money outstanding on credit cards, car loans, things like that. Because the problem is the interest rates on these are absolutely terrible, and compound interest, which is an amazing tool for building wealth, is actually working against you. On credit cards, you have an interest rate of about 22% per annum, which is just insane. And a lot of car loans are very much the same. Some you can finance at a really low rate. But what you have to remember is at the end of the day, all of these debts are taking money out of your pocket. They're taking extra money out of your pocket. It's not just the cost of, say, the car or the cost of whatever you buy on the credit card. You're also paying extra on top of that. So all of these things are working against you. So if you have consumer debt, it just has to go. You have to work towards absolutely getting rid of that before you even start thinking of investing. And, to some people, this might be an unpopular thing, but that's personally what I believe. So remember, there's nothing wrong with using credit cards. I use credit cards for everything to generate points on things that I was already going to spend on. So I have a lot of airline miles. I think I've got 700,000 just from making purchases that I was already going to make. So there's nothing wrong with using credit cards, but that balance needs to be paid off every single month. You don't want to be paying a cent of interest extra to the bank. So from here, something else that you should do to set yourself up financially is have a look at your income. Is there anything that you can possibly do to help generate more income? Because at the end of the day, to build wealth, it all comes down to the size of your shovel and the size of your expenses. So the more you can do to grow your shovel and make that move more stuff, then you're going to generate better returns in the long run from a pure dollar perspective. So maybe you could look at taking up a second job while you're young. Maybe you could look at finding ways to get a promotion. Maybe you can move companies and get a better pay rate. You know, this is something that has been researched, and people that tend to move around from company to company end up making more money than someone that stays at the one company for like 20 years. So there's a lot of different ways to make money in this world, and a lot of it just comes down to the skills that you can learn over time. You know, if you can learn a high income skill and then you can attach that with another high income skill, then the results are just exponentially increased. So it's really something to think about, is what's something that you're really good at that not too many people in the world are really offering, and how can you combine not only that skill, but that with something else. So, you know, there's so many examples of this, and it all comes down to you as a person. You know, what are you good at? Because we're all good at different things. It makes all kinds of people to make a world. So when you're at the baseline and you have a net worth of under $1 million, it's really important to know that income is significantly more important than investing at this particular point. On top of this, frivolous spending is like gravity to your financial goals. If you're out spending heaps of money on Uber Eats and, you know, going out to restaurants heaps and, you know, just making lots of purchases online off eBay or Amazon, you know, all those things are going to be like gravity because they're going to be taking away your power to invest. Okay, so once you've gotten rid of your consumer debts, you've got your emergency fund, you know, you've looked at what you can do with your income, then perhaps it's time to start investing. So I personally believe that you should be putting at least 20% of your income away. Now, for everyone, this is not going to be possible. I understand that if you live in Sydney, things are quite expensive. If you live in Melbourne, things are quite expensive. But the thing is, 10% I personally don't believe is going to be enough to retire on. I think what we're going to see in the next however long is the returns from investments are just going to be lower. You know, purely because we've seen such an insane amount of growth in recent years. So we might not see a crash. Hell, we might see a crash. But personally, I just think, you know, the returns are just going to be lower. So I'd be looking at investing at least 20%. I did some calculations last year. For me, I was doing about 50% of my income. Now, thankfully, I can do that because my income is way bigger than my expenses. So just have a look at what you can cut out of your expenses. So I'd be saying at least 20%. You know, don't kill yourself over this. You know, you got to enjoy your life and have a bit of fun and go out. But it's really important to make sure that you're planned for the future so you can enjoy that quality of life for the rest of your life. So once you've set aside about 20% of your income every paycheck or every time you get paid, what you want to do is have a look at some of the different options for investing. So one of the best ways to get started investing is in the stock market. Now there's a lot of pros to the stock market, and one of the pros is that it's really easy to get started with not that much money. So it's something to take into account. Obviously with real estate, if you want to do some real estate investing, you're going to have to have at least 100 grand easily to even get in the game. You know, like after you're putting 10% down and, you know, you've got things like stamp duty, any other government charges, you know, loan costs, there's a lot of money that goes into that. So, you know, you need to have at least 80 to 100 grand to even get started in real estate. So if you don't have that kind of money, and a lot of people don't, then the best way to get started is probably in stocks. I have a link to a brokerage which I use in the description. You know, if you want to get yourself a free stock and get started, please click on that link. And when you deposit money, that's when you'll get a free stock. Could be GoPro or Dropbox, or it could be Nike. So that is with Stake, and that's where I do all my investing in the US. So there's thousands and thousands of stocks that you can choose from, but there's also things called index funds. And this is probably one of the most safe ways to generate a return over the long term in the stock market. So what an index does is it tracks a number of different companies all in one. So what you'll see is an index fund or an ETF, which is an exchange traded fund, such as the A200, which is from a company called BetaShares. So if you look at getting into an ETF like this, what that does is it tracks the top 200 companies in Australia. So by buying into that ETF, you have exposure not only to the Commonwealth Bank, ANZ, Westpac, all of these large banks, Woolworths, like all of these companies that are big companies in our lives in Australia today, but you get access to all of the mining companies such as BHP, Rio Tinto, and so many others. There's 200 companies there. So these are fantastic because if one of these companies goes bankrupt, it doesn't matter too much because you've got 199 other ones which are there still propping up your investments. So what you'll see is broad diversification means that you're a lot safer and you're exposed to a lot of different sectors. If retail's getting crushed like it is now, you're still in mining, which is doing fantastic, and vice versa. I'm not in the business of telling people what to invest in, but what we've seen in the past is that investing in index funds such as this or the S&P 500, which tracks the top 500 companies in the US, what we've seen over the past and over the long term is that investing in index fund has been the way to generate long-term reliable wealth. If you've parked your money in the S&P 500 for the last 20 years or any period of time, like any period in time from investing in the S&P 500, you are up on your initial investment. You can pick any period. You could have started in the 1940s, you could have started in the 1960s. If you held your money and reinvested dividends, then if you hold over 20 years, you're up on your investment. And that's what's happened in the past. You know, that's probably what's going to happen in the future also. And of course, over time, you have compound interest working with you. So the stock market, the indexes return about 7 to 9 to 10% on average every single year. And what that means is that say you invest $1,000 the next year, that's worth $1,010. And then your $1,010 is then compounded. So if you're continually adding to this over time, then you're getting that compound effect, which is just fantastic for growing your wealth, especially over long periods of time. So after doing this over a few years, you might find that you've saved up enough money to get into real estate. Now, real estate is one of the most incredible tools for generating wealth and becoming really wealthy. What we've seen from some studies is that people who have invested in real estate, it's about 9 out of 10 millionaires are the people that have invested in real estate. So obviously you have the leverage factor. Which is a lot safer. You can use leverage in stocks, absolutely, but it's really unsafe. You can completely blow up your account if you do that wrong. But with real estate, it's much slower moving, which means it can be a little bit safer than what you would expect in the stock market. You know, you could lose, basically your entire account within seconds if you're leveraged. But with real estate, that's just not going to happen. Of course, the barrier to entry is a lot higher. You'll need 10 to 20% of the purchase price of the property, which can be quite a lot. So to get the median house in Sydney, so this is excluding stamp duty and all the other charges, with 10% down, you're going to need at least $100,000. You can find some cheaper options. Let's say you're in Brisbane, you might be able to find yourself a property that's worth $500,000, and then obviously you can use 10% of that, which is $50,000, but you also need to remember there's closing costs on that, such as stamp duty and other government charges. So, you might be up for more like 60 or 70,000. The government does have some schemes such as the first homeowners grant, and also they'll wipe out your stamp duty if it's your first home rather than an investment. There's much debate about whether it's better to rent or to own. A lot of people will rent and then they'll invest in properties. Both strategies have merit. Personally, I think it's great to be able to own your own home because you can do whatever you want. You're not tied up in a rental lease and constantly having to move around the place. And of course, the mortgage is going to take money away from your borrowing power. But if you're buying in the correct area, then you're going to see a lot of capital appreciation over time, which outweighs those cash flow issues on top of having somewhere to live. I think that's much more important. What I've done recently is actually a cash out refinance where I've been able to take money out of my primary place of residence to go and invest in new properties. Completely tax-free, free money to invest. So if you've been doing this, you should have grown your stock portfolio. That should have gotten a little bit bigger. And then of course, if you've purchased a property by this point, you do this for a few years, you should have some equity in your property. So now what you do is you take all that and you throw it in Dogecoin. Buying the dip, buying the dip. Absolutely not. No, do not do that. It's a terrible, terrible piece of information. Do not do that. It's a joke. So after you've built, a reasonable stock portfolio and you have some equity in your property, you might be able to use the equity in that property to go and put a down payment on a rental property. And this is a very common strategy that people use to grow their wealth. Is they'll purchase a property and they'll hold on to it for a little while. It might grow a little bit in value. The mortgage might get paid down a little bit, and you've got a little bit of wiggle room there with both of those things to then take money out of that property and go and invest in more. And you can imagine, this is like the compounding effect. If you do this for a long period of time and you end up with like 10 properties, it's going to be way easier to get the 11th and the 12th and the 20th and so on and so forth. Obviously you can't do this forever, because eventually the bank is going to have a debt ceiling, and they're going to look at that and go, well, we just can't lend you any more money because it's a bit more of a risk. And at that point, that's when you have to start paying down the debt so you can get hold of more money. So you can basically repeat it indefinitely, but it is going to have a cap on it based on what your income is. And that's why when you're looking for rental properties, it's really important to find something that has a positive cash flow. A lot of people negative gear against their tax, but of course, what kind of a strategy is it to lose money and make it later? That doesn't make much sense to me. So by doing this, by the time you get to 50 or 60, you'll be in an incredibly strong place to retire, and you won't have to rely on the government for a pension at all. Because we know that pretty much anything the government touches, they ruin. I know some people might not find that as a very popular opinion, but really, I think it's important in this world to be able to rely on yourself and some of the people in your close network. So you'll be in a very strong position by following something like this and putting away money now for the future. One of the hallmarks of successful people is the ability to delay gratification. Save today for a better future. And I think that's something that we all want, not only just for ourselves, but if you have kids, setting them up and getting them in a great place for the future. I mean, that's really what it's all about. So I'm doing this process not so much with the index funds. I pick individual stocks because I've had a little bit more experience and spent a lot of time reading reports. But with the rental property, this is what I'm doing. So I'm expecting to retire with roughly $10 million or more. This number will be different for everyone. It's based on how much you're putting into it. The money that you can borrow for investment properties, what the market does over time. So it's going to be different for everyone. This is something that we've seen work, but it might not be right for you. So make sure you talk to someone that's really qualified in this area before taking any real designated steps and taking a plan like this. So thank you guys so much for watching. I hope you enjoyed this video. I think this one was going to be a bit of a longer one, but I feel like it was a really valuable video for people. So please make sure you like and subscribe to the channel. It really helps to get these videos out to more people. So my name is Jay Sini. Thank you so much. Make sure you get your free stock from Stake. It's in the description. You deposit money, you get a free stock. How good is that? So thank you guys so much for watching, and we'll see you later.